This will bring confidence back to the markets, but from the Fed's point of view, there are additional dangers that need to be reviewed.
And of course, now there's a question, right? There's never just one cockroach.
SVB issue, that seems to, for the moment, being resolved, so the impact on markets should be somewhat limited.
The actions will stave off more and more fears of contagion, which I don't believe was warranted anyway.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The race to contain the SVB fallout. U.S. authorities act swiftly to protect bank deposits, and the Fed unveils a scheme to make it easier for banks to get short-term loans. Coming to the rescue, HSBC has emerged as a white knight. The firm has agreed to buy the UK arm of Silicon Valley Bank for £1. And markets respond. US futures rally, the dollar drops, and two-year Treasury yields plunge as traders scale back Fed rate hike bets and digest the frantic action on SVB. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, I feel a little closer to you. For the next 2 weeks, we will be only 4 hours apart instead of the usual 5 when we then change clocks here in Europe. We are also united by news flow around SVB and market response, regulator response to SVB in the US and the UK.
Wait, aren't we 6 hours apart now rather than 5?
No.
It's
4.
9 there?
It's 9.
Oh, I see. Yes, you're right. Sorry. Yeah, so I guess we are. Math is obviously not my strong suit, which is why I chose this job. We're looking at futures that are currently up about 0.5% now, and the volatility has been nuts. You know, yesterday before the Fed bailout, essentially, we were looking at futures that were down 1.5% or more. After the Fed bailout, we jumped to gains of 1.5% or more. And now that's come in a little bit, as you can see. So investors are a little bit less worried, also maybe a little bit less juiced up by what looks like a bailout and what may be the end or the slowing of the hiking cycle. We'll talk about that, I think, a lot throughout the program because a lot of people are thinking, oh, now it's a pause. Now that something's broken, maybe they'll even pivot. So we'll see how they go forward and how markets react. The 10-year yield is finally moving down now. I put the 2-year yield here because when I first checked a couple of hours ago, the 10-year yield was doing a whole lot of nothing. But the 2-year yield was really dropping, 17 basis points at the time. Now the 2-year yield is down 24 basis points, and the 10-year yield is down almost 10 itself. So we continue to see that move lower in yields as investors pile into the shorter end of the curve, but also buy the traditional safe haven 10-year. The U.S. dollar index coming down. If this were a safe haven, you wouldn't know it. We did see it react that way at the beginning of the year and last year when the dollar climbed up to, this is the Bloomberg dollar index, 1350 and change. Now we're at 1245, so investors aren't using it in that way quite as much. Take a look at the mixed picture that we saw in Asia overnight. The MSCI Asia Pacific Index up about 1/3 of 1%, a little bit less. But you had gains in Hong Kong, the Hang Seng up 2% at the close, and losses in Japan, the Nikkei down 1.1% at the close. With the U.S. dollar weakening against the Japanese yen, it can now buy less than 134 yen for $1. What do you see in your, I know now 4 hours closer to us, trade there in Europe, in the UK, and on the continent?
Yeah, this time of the year always confuses me, Matt, even without financial chaos to talk about. Let's talk about what we've seen in the banking sector and what kind of chaos that's wreaking across European stocks then. Another leg lower for European stocks today. Is this just catching up with Wall Street on Friday? Or given the fact that US futures are fading in their gains, is this another leg lower for risk assets? So we see European stocks are falling, down by more than 2% on some of the major markets across Europe. Certainly the DAX is down by more than 2%. The FTSE MIB in Italy down by more than 3%. The IBEX down by more than 2%. Over in Spain. So substantial losses coming through, and all sectors in Europe are in negative territory. Concerningly, the worst performing sector this morning is in the banking sector. We'll roll on and show you what we've got on the banking sector. That sector overall is in weakness. And last time I checked, we had 9 banks across Europe that were down by more than 5% today. So just in case you thought that maybe we've drawn a line in the sand here and the banking sector would have nothing to think about from here on, it seems that's not the case. Here's the banking sector here in Europe down by 4% in in aggregate. As I say, some of those banks down by more than 5%, 9 of them on my last count. Interestingly, then, this risk-off scenario that we're seeing, as shown to us by banking stocks falling, we're not seeing that necessarily in currency markets. The dollar has been retreating. That's left room for the euro to gain, the pound to gain. So this is just the other side of that dollar trade. It's the dollar weakness trade that we're really focused on today. HSBC down by 3%, but as I mentioned, it's in good company. So this is not necessarily to do with the fact they've spent £1 bailing out SVB UK. What kind of assurances have they had from the UK government around this business as well? That's an interesting one to pursue. And here, thinking about where we are in the global yield story then, Matt, we have, of course, seen a lot of appetite for fixed income. Those yields coming down, that's been a big story over the last few days. That continues to be the story here in the UK. Is that about money going into the perceived safety of bonds, or is it all about reassessing just how many hikes we're going to see from here, if at all, from various central banks around the world?
Yeah, absolutely. I think that's one of the big questions people come away with after this big bailout. Let's talk about the extraordinary measures U.S. authorities have taken to shore up confidence in the financial system after the collapse of Silicon Valley Bank, introducing a new backstop for banks that Fed officials say is big enough to protect all of the nation's deposits beyond what's insured. Everything, I think $19 trillion worth. Belita Ong, Dalton Investments chairman, spoke with Bloomberg after the announcement.
I'm very relieved to see that the authorities got together and agreed to guarantee deposits, because their actions will stave off more and more fears of contagion, which I don't believe was warranted anyway, because the problems with SVB were because of this big mismatch between assets and liabilities.
We've got team coverage here on the race to contain the fallout. Markets correspondent Kriti Gupta is tracking the U.S. response for us. Shonali Basak, our global finance correspondent, has the latest on Wall Street's response. And Lizzie Burden is covering the U.K. response for us with HSBC's takeover. Kriti, we'll start with you. Walk us through these U.S. actions. Massive bailout. And I guess a bail-in of shareholders and some bondholders.
Yeah, so we got to be careful with the bailout terminology, simply because technically it's not the same bailout you saw in the global financial crisis. But what you really do need to know is this really nerdy term called the discount window. And this is really important as we talk about the Fed funds rate. Basically, when you see these changes in the rate, what we're talking about, a peak policy rate now priced in about 5%. We'll get to that in a moment. That's more affecting your interbank lending rate. Essentially, say your banks, when they need liquidity, they're kind of borrowing from each other and returning money from each other. There is a stigma, though, and kind of an emergency measure around borrowing directly from the Federal Reserve. And this is what they did. The Federal Reserve and the FDIC basically saying, look, the discount window, which ordinarily you could only borrow for about 90 days, now you can do it for a year. And essentially what that does is create this kind of backstop for a lot of the folks who need to actually, a lot of the regional banks, I should say, need that extra liquidity to help cover some of their kind of extraordinary risk-taking, is the way it's been phrased by certain members of the media and certain high-profile investors on Wall Street as well, part of which is really a result of some of the repeals you're seeing in the Dodd-Frank Act as well. Again, up to kind of speculation on what has actually led to this. I'll let Shonali get to that in a moment. But what you really need to know is some of these regional banks are now seeing so much pain and so in terms of their stock price that what is happening is that their prices are dropping almost below their book value. So from a market trading perspective, even though you do have this backstop from the Federal Reserve, there is still the stigma that whether they're actually going to access those facilities, and not just the ones that are being kind of recovered, but the ones that are still trading.
Okay, so that is the BTFP, the catchy acronym that you're referring to there, that's being talked about. That's one part of what we've seen from US regulators. Also, as Matt was referring to, we've seen the full protection of depositors at Signature as well as at SVB. What about what all of this means for monetary policy then? Goldman Sachs, for example, scrapping their March rate hike call, but not everyone in the market is on the same page here.
Yeah, it's been an extraordinary 24 hours when you look at Fed pricing, and specifically because we're looking at a peak policy rate, which, by the way, on end of close Friday was at about 5.7%, peaking in September. Now we're looking at a terminal rate of about 5%, led by some calls coming from, say, Goldman Sachs and Evercore as well. Goldman Sachs specifically, which, by the way, again, on Friday was sticking to a 25 basis point call, leaning towards the odds of potentially 50, given the very hot data points that we had gotten. They're saying, look, now to reinstate some confidence in the banking system, the Federal Reserve isn't even going to hike. They're going to pause altogether. It's It's a take shared by Evercore's Ed Hyman as well. The idea here simply being that you can't actually hike if you're starting to see systemic risk, and that's really what's driving even yields lower, and of course Fed swaps as well.
All right, Kriti, thanks very much for that. Kriti Gupta talking us through Wall Street's reaction in terms of the markets. Ed Hyman there saying that the Fed is due for a pause now. Let's get to global Wall Street with Sonali Basak. Pershing Square's Bill Ackman praised the swift action by U.S. regulators, though he cautioned that more banks may fail. Sonali Basak, our global finance correspondent, has more on responses to the collapse of SVB, and now we know Signature and the big Fed bailout.
Yeah, well, the bailout terminology, that's the thing that is up for debate out there in the ether.
I mean, still, it's a bailout of depositors, right?
It's a bailout of depositors, but the difference to Kriti's point here is in 2008, there was some protection here of bondholders and equity holders. So what the government is telling you is that they're trying to put the depositors first, and they are trying to make sure that that moral hazard doesn't exist among investors. Remember, when you think about what Bill Ackman is saying, that was the point he was making, but the bailout that people are concerned about, to your point, a lot of these depositors were Silicon Valley, a lot of venture capital firms. So was this a bailout?
Circle was holding $3 billion at SVB. You're only insured to $250,000.
And to the point,
so they should have been worried. Now they don't have to be worried.
I think they don't have to be worried, exactly. And you saw, for example, that USDC, that stablecoin peg, regain its peg last night immediately on top of this Fed news. But to the point you're making here, who was it a bailout of? When you think about the depositors here as well, the concern here, the government is trying to give you confidence that depositor money in a U.S. bank is insured ultimately. But this is pretty unprecedented in a lot of ways because of the way they structured this. Bill Ackman, like you said, believes more banks would fail. That is kind of a popular view at this point. But the point of the government response here was to ensure that doesn't happen. To your point, also, there are a lot of regional banks that are still under pressure. Pre-market trading today, banks like First Republic, Western Alliance, PacWest, people with similar types of deposit bases or a lot of money above that 250K threshold. But there's a lot of concerns about what this means for the banking system ahead.
Okay, so is that what we watch next then, Sonali, on this? We watch the smaller end of the U.S. banking scene.
We have to watch the smaller end here, Anna. And, you know, you think about what Treasury officials have briefed people on yesterday. Bloomberg's own reporting here by Chris Condon, Josh Wingrove, others had shown you that the government officials were worried about other banks. That was part of the reason that they had taken all of these actions. We would also watch the response here from, of course, that big 50 basis point move, whether it happens or not, or whether any rate hike happens into next week. How much stress do officials really see on the American economy? You have the likes of Jeff Gundlach now saying that a recession looks imminent with the way the steepening yield curve is looking. Is it? And again, how much more pain has to be felt among the financial system and their clients as we get there?
Okay, thanks very much, Sonali. Bloomberg's Sonali Basak with the latest on global Wall Street's take on these developments. Let's get to the UK and the UK side of this. After a frantic weekend of negotiations, HSBC says it's buying the UK arm of Silicon Valley Bank for £1. After the deal was announced, the UK Chancellor of the Exchequer defended the UK banking system.
We could have seen some of our most important companies, our most strategic companies, wiped out, and that would have been extremely dangerous. The UK banking system is extremely secure, it's well capitalised, and I think we demonstrated that resilience by what was happening over the weekend and the fact that we were able to come up with a solution so quickly.
Now it's back.
Let's bring in Bloomberg's UK economic correspondent, Lizzie Burden, who's with us on set here in London with details. Lizzie, good morning. What are those UK details?
Well, you can see the relief from the Chancellor, Jeremy Hunt, there, that the solution has been found. So HSBC, as you say, buying SVB for £1. Crucially, it's a private sale that goes through immediately, so it doesn't involve taxpayers' cash. That would have been controversial, shall we say, optically, ahead of his budget on Wednesday, given he's under pressure to support ordinary Britons through the cost of living crisis. But also it was important that a solution was found, given the pressure on him to grow the economy and his stated ambition of making Britain a tech superpower. We know that even though there was less concern about the contagion risk to the financial sector in the UK, most of SVB's depositors are in tech, and and many of them had deposits over the £85,000 threshold for protection, actually in the millions, and they needed this support in order to pay their staff and pay their suppliers. So the Bank of England has said that these deposits are now safe, and SVB UK will not be going through the insolvency procedure.
All right, so what does this mean for the UK budget on Wednesday?
Well, hopefully there won't be too long a shadow cast over the budget. However, before the announcement, Matt, we did hear from Shadow Chancellor Rachel Reeves of the opposition Labour Party, and Reeves said that it's a wake-up call, underscoring just how reliant the UK is on foreign investors for capital. Of course, it also comes off the back of ARM choosing to list in the US instead of London. So the question isn't just how the Chancellor can grow the tech sector, but also how he can protect what is already in existence. It also has consequences for the Bank of England. Pretty mentioned Goldman Sachs changing its call for the Fed. Well, if you look at market pricing, before this saga on SVB, after Powell's comments last week, there were moments when traders were pricing a peak of 5% for the Bank of England. Now it's looking more like 4.5% in the autumn, and where previously a 25 basis point hike next week was more than fully priced in, now the chance is just 75%.
OK, thanks very much, Lizzie. Lizzie Burden with the latest on the UK regulatory response to the SVB UK part of this. We'll hear more about Europe's response to the SVB fallout later this hour, when Maria Tadeo, our colleague, speaks with the Eurogroup president, Paschal Donohoe. And with that in mind, we see a couple of banks halted limit down in the Italian trading session. I can now see at least 10 banks down more than 5% here in Europe. So a sense that we are not necessarily at the end of this story. Coming up, we will get further analysis on SVB with Ben Emons, who joins us, New Edge Wealth Senior Portfolio Manager. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York with Anna Edwards in London. Now, in times of turmoil, we often look at the TED spread, which is the spread between 3-month treasuries and Eurodollar futures, or 3-month treasuries and now 3-month LIBOR. And it is not nearly as bad as it was when we first learned that COVID would lock down all economies around the world and result in the complete shutdown of the economic engine. But it is still pretty bad, and it's not getting much better this morning. Joining us now from Paris is Bloomberg Senior Equities Editor Phil Serafino. Phil, we've seen a lot of volatility. Sentiment was very negative on Saturday and Sunday. After we got the bailout, it was very positive, and now it's come back down. Where do we sit?
Yeah, I mean, it feels like you can't even look away from the screens for 5 or 10 minutes. When I came in this morning, things were looking very strong, and now it's fading. It just shows how fragile the market is at this juncture. I mean, look, the basic bull case today, this morning, was maybe the Fed will be a bit less aggressive in raising rates. The U.S. is doing what it takes to contain any possible contagion. I guess that's okay for stocks, but it's not a great argument for the bull case. I mean, if you look beyond today and beyond the fallout from SVB, you're back to a situation where, the Fed has made it clear they're going to keep inflation under control. So sure, maybe like as Goldman Sachs says, maybe they don't do a rate increase next week. But at some point, the Fed is going to be back on the effort to keep inflation under control. And that doesn't really bode well for the equity market at this point.
Yeah, Phil, thinking about European banks, we saw them fall heavily in Friday's session. We've seen the UK government take action on the UK side of this. So it's quite interesting to see the extent of negativity around the sector continuing today. Now, 14 European banks falling just this morning, more than 5%. Is that just because they've rallied a long way, and also in conjunction with a reassessment of just how high the ECB goes on interest rates, rather than any concerns around the health of the sector, perhaps?
Yeah, I mean, we had the French finance minister out this morning saying, look, there is no real risk of contagion for French banks. It's a different situation. The European banks don't have the kind of exposure that SVB has. But it is true, those banks have rallied a long way. They were the big leaders in the market rally from, say, late October or late September through the peak. And so, yeah, investors are just a little skittish, and they're pulling out of the stocks that have done the best.
Yeah, and certainly there was a lot of expectation around those margins, and they had done pretty well. Phil, thanks very much. Bloomberg's Phil Serafino joining us there with the latest on global markets. For more market analysis, check out MLIV Go on your Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
Now keeping you up to date with news from around the world, here's the first word. In Norway, NATO forces are gathered for joint drills as the Defense Alliance, along with Russia, China, and others, compete for greater control of the Arctic. Estimates suggest the region holds around 1/4 of the globe's oil and natural gas resources. Meanwhile, Ukraine's interior minister says Russian missiles and artillery have destroyed more than 152,000 residential buildings since the start of the invasion. And new Premier Li Qiang called for China and the U.S. to cooperate better, potentially opening the door for a call between President Biden and Xi Jinping. The comments suggest a new willingness by China to resume talks with the U.S. since the alleged spy balloon incident. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The race to contain the SVB fallout. U.S. authorities act swiftly to protect bank deposits. And the Fed unveils a scheme to make it easier for banks to get short-term loans. Coming to the rescue, HSBC has emerged as a UK white knight. The firm has agreed to buy the UK arm of Silicon Valley Bank for £1. And markets respond. U.S. futures rally, the dollar drops, and two-year Treasury yields plunge as traders scale back Fed rate hike bets and digest the frantic action on SVB. I'm Anna Edwards in London with Matt Miller in New York. And Matt, I said there that US futures rally. I mean, are they just still in positive territory? Or are we now flatlining? They were positive, now flatlining. We've worked through, it seems, some of the optimism and dispensed with it already.
It's gone, yeah. I think it's really interesting. You know, I was, like I think most everybody else who watches financial markets, glued to my phone over the weekend, thinking every 5 or 10 minutes I needed to check again because something could change. And that really is the way it's going. We had futures down almost 2% yesterday, and then when the Fed came in with this huge bailout, I really can't imagine using any other word. Of course, it's a bailout of at least depositors. You had futures just off to the races, up almost 2%. Now we're back down just 1/10% on the S&P, which is really interesting. And I would look at the stock 600 to see if you're now back down through the 100-day moving average, because I saw it was very close a moment ago. The U.S. 10-year yield is off right now 30 basis points. So after the amazing move down we saw on Friday, we're seeing a continued move down in line with the same severity. The 10-year yield is down 13 basis points. So the beginning of the curve hit hard, but we're seeing it in the middle of the curve as well. Pretty unbelievable moves. The Bloomberg Dollar Index off 0.5%. We haven't seen much change there at 1247, but certainly not the safe haven that it has been in other times. Last year it approached 1353, 1354, so we're well over 100 points off of that. In terms of some of the movers that we're seeing in the pre-market, First Republic, I think, is one of the most notable, down 54%, even after the Fed has essentially agreed to backstop all deposits, meaning there's no reason for any run on a bank now because depositors can be guaranteed whether you've got $3 or $3 billion in there, you're going to get your money back. That means a bank like First Republic, if it's sitting on massive long-term hold to maturity portfolio, it can still sit and hold that portfolio for at least a while, and if there's no run, forever. Western Alliance Bancorp down 21%. I think very interesting, the same reason. Schwab had bounced this morning, so when I looked at most U4 at 3 o'clock, Schwab was up. I know it was hurt on Friday and over the weekend. It's back down 5% right now, which is very interesting because, I mean, that's a company, a bank that has most of its deposits under that $250,000 limit, which was previously important, and now, I mean, who cares about that? One interesting mover to talk about on the upside is Prevention Bio. Those shares up in the pre-market after Sanofi agreed to buy the biotech for $25 a share in cash. They're trading at $24.07. It's a $2.9 billion deal. It'll bolster Sanofi's portfolio of diabetes medicine because Provention has a recently approved medicine for that in the U.S. But really, our big focus, obviously, is on the banking industry, Anna, and the fallout, the contagion of that to markets around the globe.
Yeah, absolutely. Is it about the contagion, or is it about just a reassessment of what kind of margins these businesses are going to make if rates don't go quite as high? We will get some guest opinions on that shortly, because we are seeing substantial moves for European banks, Matt, to your point. Stocks Europe 600 then being dragged down by the financial services sector, by the banking sector, down by 2.75%. So even though we've seen comprehensive action, it would seem, being taken by the UK government, and that's been the biggest European expression of this nervousness around SVB UK. Some news lines out of BaFin just recently about what they're doing in Germany. So we're seeing action being taken by regulators, but we're not ready to draw a line in the sand, it would seem. Stocks 600 banks index down by 5.9%, and more than 10 banks down by more than 5% earlier on today. So certainly we are seeing material moves, and some of them being, in Matt's terminology, decimated. Some of the banks in Europe losing more than 10%. But is it to do with this? Is it to do with what we're seeing on the rates market? Is it the fact that it looks set for the biggest drop ever in the 2-year yield over in Germany? And if that is the case, what is that doing to people's assessment of what profits will be made in the banking sector? And here's HSBC. It's falling really in line with others, and not necessarily anything to do with the fact they've spent £1 whole buying SVB UK, acting as a white knight in the UK part of this drama, Matt.
Yeah, very interesting. And I will note that the Stocks Europe 600 is now down below its 100-day moving average. So, in one session, falling through its 200-day moving average and its 100-day moving average, that shows you the severity of the move down for the European benchmark index. Let's talk about all of this right now with Ben Emmons of New Edge Wealth. He's a senior portfolio manager and head of fixed income there, but really commentary, Ben, that I think everybody has been reading of yours since this all started, keeping us abreast of each and every change throughout the weekend. I like the point that you make that now, by enabling the FDIC to fully protect depositors, the Fed has provided a de facto backstop to all of the $19 trillion of deposits in the U.S. So everything is safe now. The $250,000 limit is just out the window.
Yeah, I think we can conclude that, Matt, and that was obviously important. The Fed must fulfill its role as lender of last resort, and the Treasury must enable the FDIC to guarantee deposits, because if you have seen what happened last week in the span of 24 hours, seeing 2 banks now fail, because people pull their money out and they're worried, you want to stop that dynamic. But as you were discussing, the dynamic that's playing out in the financial markets currently is about that it is not just only protecting the depositors, it's about bailing in the stockholders and bondholders of banks to guarantee those depositors. And I think this is why we're seeing a negative reaction coming through in Europe and in Asia, because people look at this saying, like, if the US goes this direction, this is not just only for US banks, right? This is also something that, basically echoes in other markets. So I think this is why you're seeing a negative reaction in stock markets and yields being down.
But by the way, even though all deposits are protected at this point, Ben, it looks like the market is saying that doesn't mean other banks won't be shut down by the FDIC, right? I think a lot of people were surprised that Signature had been seized yesterday in that announcement. And we're seeing, for example, First Republic off again more than 50% in the pre-market. Do you assume that the FDIC is going to move in and shutter a few more institutions?
So that remains a bit speculative currently, Matt, because you're right that both these banks, First Republic and Pacific Western, are still down in the pre-market. So there's worry among those who hold those stocks that something may happen there, but it's hard to say if that actually will. That depends obviously on if their deposit base is depleted so much they have to access the window of the Fed now to get liquidity, in addition to having to, I guess, liquidate some of their portfolios in order to raise more capital to protect the depositors. So that's a story to be played out. People try and anticipate it, obviously. And because these two stocks were down at the same time that Silicon Valley Bank and Signature were down, I think that's just a continuation of the story. And that was what I was worried about. I thought, like, this is a really important step that the Fed and the FDIC and Treasury took, and it's really important for people to understand that your money is safe in the bank and you do not have to worry about deposits you have there. On the other hand, the stock and bond holders are not protected, as they clearly specified that in the statement. I think that overhangs those two banks still this morning, why you're seeing that flight to safety bid in Treasuries.
So, Ben, to use the terminology you've used this morning and also, takes us back to 2008, you would describe this as Main Street being bailed out and Wall Street being bailed in. Does that mean we're not at the end of this? We'll hear more from US regulators?
I think it's likely, Anna. I mean, it is kind of extraordinary to see the bill in so specifically stated, because previously we did not have that, right? The banks got preferred stock, or what you've seen in Europe too, big liquidity injections into the banking system to ring fence banks. But we're now ring fencing, so to speak, the depositors, and that's, I think, different. So, getting into this stage means then that, yes, you can invest in banks. I mean, it's an opportunity, but on the other hand, it's also about how banks manage their balance sheets. And I think this is what people do with their analysis. Who manages better than the other? And that's your winner loser analysis that we're going to do.
Ben, we were asking for months, I think, what's going to break here. We got a sense of that on Friday. Now that something has broken, does that mean we see a pause from the Fed, or do they still face inflation challenges? And so actually the risk for markets is we face tighter financial conditions, but still have inflation.
Yeah, it's a major challenge, and I think that markets are making this round trip quickly. During the Powell testimony last week, the October Fed funds futures priced in the 5.75% Fed funds rate in the fall. That's completely taken out, with this two-year yield now dropping almost 75 basis points. So markets are quick to judge to say that Fed, probably that level of rates was really the breaking point that everybody's talking about. And so how far can you really go with a campaign here, as then the real amplification of your policy comes through the banking system and then onto the economy. And so I do think, Anna, that this what we have experienced with Silicon Valley Bank will have an impact on the economy negatively. Why yields are lower today too. I think that explains that. And indeed, that we're getting to a point that the Fed can say, as that all is happening, there will be an effect on inflation too, and you can further moderate tightening. I do, though, think that they will go for this rate hike on March 22nd. Not only because they've signaled that or communicated it, but the inflation rate is just too high. It's coming out, obviously, in the next 2 days. It's just too high, as you've seen in other data, including the jobs report on Friday.
Ben, thank you very much. Thanks for joining us. Ben Emons of New Edge Wealth. And even if Goldman Sachs says there won't be a rate hike in March, there are still many like Ben who are saying that we will see something. Some voices earlier on telling me maybe not 50, maybe that 25. The work function moving around a lot in the last hour or so. Coming up on the programme, more on the SVB fallout and what it means for Europe. We've seen substantial losses on European banks during Friday's session and once again today. We'll be speaking to the Eurogroup president. A timely conversation with Paschal Donohoe. That's next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Steve Ratner, Willett Advisor Chairman and CEO. That's at 2:30 p.m. in New York, 7:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. The French Finance Minister, Bruno Le Maire, says he sees no risk of contagion from the collapse of Silicon Valley Bank in Europe. Speaking on France Info television, he said, quote, "What happened in the US is very unique with a bank that is exposed exclusively to the tech sector." Let's continue to review what SVB means around the world and specifically for European banking now. Bloomberg's Maria Tadeo is with Eurogroup President and Irish Public Expenditure Minister Paschal Donohoe ahead of today's Eurogroup meeting in Brussels. Maria.
Yes, Anna, good morning. And by the way, the agenda here obviously completely out the window because of the situation that we've seen over the past 24 hours. And Mr. Donohoe, thank you so much for joining us on Bloomberg. We always talk macro, but this morning it feels completely different. There's a lot of jitters on the market, especially when you look at the banking sector, European banks. What is going on here? And just quite frankly, very simply, are you concerned?
Well, we'll be getting an update today from our regulators with regard to the developments that have taken place both globally in Europe over the last number of days and hours. If I look at where we stand at the moment, the exposure that the euro area has to the Silicon Valley Bank Corporation is very limited. We have a very strong regulatory and resolution framework here in Ireland, in Europe, I should say. But of course, any banking development such as this does prompt questions, and of course we'll discuss this today in the Eurogroup.
And you just said something important. You said we're going to talk with the regulator, so I assume you have been over the weekend on the phone with the European banking regulator?
Well, we'll be getting an update today. We will have both the Commission
and on the case.
Well, the Commission and the ECB, of course, have been monitoring developments that have been taking place, and they will be in a position to discuss this matter with finance ministers today. We do face into this kind of development, as I said, with a limited exposure within the euro area at the moment and with a very strong regulatory and resolution framework. But even with that in place, of course, it's a matter that will receive focus today in the Eurogroup.
And of course, when we talk about this exposure, we know there are some operations in Germany. There's also in Denmark. You also mentioned, by the way, in Ireland. You obviously know that economy very well. And we also understand there's some in Poland. Having said that, when you look at the overall banking sector today, you see banks that are unrelated, not even in those jurisdictions, that are majorly down. So what is going on here? Is this panic to you? What's going on?
Well, it's just a reminder that risk and moments of change can happen very unexpectedly. We saw that what has now happened in America. And with those developments taking place at the moment, I'm not going to comment on equity movements that are happening across the morning. The key message here is that from a European perspective, we are well positioned. We've made such changes in our regulatory framework over the last decade. We can monitor and respond back to developments if needs be.
And of course, you're not going to comment on individual equity names. We have talked, however, on the show about a number of banks that even went limit down this morning. But I do wonder, however, what's your message to investors? Not getting specifically into specific banks. I know you're not going to do that. But is your message to investors maybe cool down, look at the fundamentals? A lot of this seems to be a knee-jerk reaction. Is that basically what you want to say?
Well, I think there's three messages worth emphasising this morning.
Okay,
the first one is our understanding of what the exposure is due to developments that are taking place in America, our ability to track that. Number two, the confidence that we have in the developments that have taken place in the banking regulatory framework within the euro area. And then thirdly, beyond the investors that you're speaking of there, of course, I'm very much aware of the importance of the tech sector within Europe and how they were supported via this bank. And of course, what we will be doing at EU and at national level is looking at how we can support our tech sector to ensure that they're still in a position to grow and that their prospects are not significantly impacted by the development that has taken place.
And you talk about the regulation, and obviously your message, based how I understand it, is the European regulation is strong, and actually you would say probably better than some other jurisdictions. But when it comes to the tech sector, would you say, again, this proves that maybe there are some deficiencies there?
Well, we are, for other reasons, seeing changes taking place in the tech sector all over the world. But I look at where we are in Europe at the moment. While I can see changes that are taking place in the global tech sector that, of course, then affect our presence in Europe, much of the change that's taking place there for me is understood as a moderation in the huge growth that happened during the pandemic. As to whether there's too much risk, no, I think our banking system in Europe at the moment understands the risk within European and global tech very well and has the right measures in place to manage that risk and to be able to deal with it in the time ahead.
And Mr. Donohoe, I have to ask you about the macro, which in some ways is connected to the story today. We have seen this repricing about the rate expectations from the European Central Bank is a complete change in narrative. Last week we were talking about the European Central Bank definitely hiking 50 basis points this week. It seems maybe the market, given the jitters, is perhaps having second thoughts. How do you see the situation going? Is this a situation where you say inflation is an entirely separate issue and the European Central Bank independently, but has to stay the path? There's no reason to change the narrative.
I think the ECB narrative has been very, very clear. They're fully independent in their functions and decisions they make, but they have emphasised that we all need to play a role in getting inflation down, and they're committed to that journey. But they've also said that they will make decisions meeting by meeting in a data and evidence-based way, and that narrative is still very clear. Inflation within the euro area is coming down, but it's still too high, and we have work at fiscal and monetary level to do to get it back to where it needs to be.
And core inflation is, by the way, very sticky, yet nonetheless, today the market is suggesting something different based on the fallout of everything that we've seen over the past 24 hours. I wonder, is that the wrong message, though? I mean, when you look at it, do you say that these two stories are unrelated?
Well, I think undoubtedly changes that are taking place in monetary policy, changes that are taking place in interest rate expectations have fundamental effects everywhere. And of course, this is one of the background factors in what is now happening at the moment. But amidst this kind of change, it's why it is so important to be clear about a policy position and narrative with regard to inflation, which is, as the ECB have articulated, and then both today and tomorrow, you'll see finance ministers here within the European Union again emphasise the message that we all have to play our role in getting inflation down.
And just one final question, yes or no answer. Do you have full faith in the European banking sector and the European financial sector?
I have a very, very high level of confidence in both where we are from a regulatory perspective and also in changes that have taken place within European banks to respond back to the challenges of a decade ago and to get ready for the challenges that lie ahead. So yes, that confidence is there, but at the same time, we never have any reason to be complacent. We know how fast things can change, and it's why in a timely way today, we'll be able to get an update on where things stand at the moment. But I am confident that we have the ability to manage these kind of risks.
And they certainly have over the past 24 hours. Mr. Donohoe, thank you so much.
Thank you,
Appreciate it. Always
Thank you very much.
Thank you very much. And of course, that was Paschal Donohoe, head of the Eurogroup. And, you know, you heard it there. A lot of the conversation here, I'm sure, will be about how the banking sector is going to perform in the next few hours on a very jittery morning also too in Europe.
Yeah, absolutely. We see prices dropping. That indicates concern for sure. Maria Tadeo, thank you very much for that interview from Brussels. Now let's continue to talk about the fallout and the race to contain the Silicon Valley Bank failure. The action that we're seeing in smaller U.S. banks this morning has been concerning, to say the least, even after the Fed essentially backstopped all deposits across the entire U.S. system. We're joined by Herman Chan, Bloomberg Intelligence senior analyst. He's focused on U.S. regional banks. Herman, thanks so much for coming in early. I'm sure you've been unable to sleep anyway, considering the news flow. Things are changing every 5 or 10 minutes.
No doubt about it.
What's your take on, the pessimistic view that markets are taking on, for example, First Republic and other banks, even considering this giant backstop from the Fed?
That's right, Matt. When we first saw the news last night that the Fed was coming in with a new liquidity facility and also backstopping the depositors for both Signature and SVB, that gave me a sense of comfort that the worst was going to be behind us. What the market is telling you right now, that there's a dim view on regional banks, which is a little bit puzzling given the fact that liquidity risk is now off the table. But that dim view relates to banks that are adjacent to SVB. Signature is also a faster growing business in the San Francisco area. And so that's the common thread.
What other banks, or are there other banks that look similar to SVB? They had an incredibly uniform depositor base, and they had huge losses in their hold-to-maturity portfolio. Are there other banks with similar symptoms?
So that's the thing. SVB was a very unique bank that took a lot of deposits from the startup community and venture capital community in a specific niche. There's no other publicly traded bank that is of the size that does the same businesses in the scale that SVB did. So SVB had a large held-to-maturity portfolio that was sitting on large unrealized losses. First Republic doesn't have that. Western Alliance doesn't have that. So again, it's a bit puzzling that the market's what the market is telling us today.
Herman, good morning. How would you contrast the UK and US response here? I know the US was trying to find a buyer. The UK found a buyer. It's a much smaller entity, the SVB UK unit, but HSBC has taken that on for £1. What difference does it make if you can find a buyer for this kind of business?
Yeah, that would be the best case scenario for SVB and their employees. We're hopeful that something does happen in a very short manner. The issue is that there's a lot of uncertainty within the SVB franchise at this point. You saw earlier last week venture capital folks saying that they should get their money out of SVB, which started really the run on the bank. And it is tough for a potential buyer to come in and really understand what's really left of that institution. So that uncertainty really weighs on the buying process.
Yeah, we'll look for more details as to what was discussed between the government and HSBC with that in mind, Herman, as well as the days and weeks go on. Herman, thank you very much. Herman Chan getting up early for us from Bloomberg Intelligence to give us his insights into the smaller regional banks in the United States, where a lot of the focus pre-market is, of course. That is it for early edition. Surveillance is up ahead. They'll continue to guide you through the latest twists and turns of the Silicon Valley Bank fallout. They'll be hearing also from PGIM's Greg Peters, plenty of other voices on surveillance today to take you through the latest market action. European markets then down by 2.3% on the Stoxx 600. The banking sector under pressure. The FTSE MIB in Italy down by 4.3% as gains on Nasdaq futures have reduced. We're still up 0.6% higher. E-minis up 0.1%. We wait nervously for the US Open. This is Bloomberg.